In this lesson, I'm going to talk about correlation risk. Correlation risk is also extremely important when it comes to risk management. What that means, I'll just spend a few minutes literally talking to this camera about correlation risk. But what that means, correlation risk is, let's say you're trading equities right now, and you're looking at a few different stocks within the tech sector. Let's say you have 5 really good opportunities, 5 stocks that you're looking to, as an example, short within the tech sector, technology sector, right? So you could take all 5 positions within that tech sector, but you will be risking 5% on the tech sector going down, right? So that is correlation risk. What you can do is to minimize that correlation risk, you can choose top 2 of those 5 and only risk 2% on those top 2, 1% on one, 1% on another. You're risking 2% on the tech sector going down instead of 5% on the tech sector going down, right? That is correlation risk. Correlation means that we're going to have some stocks that are very similar to each other. If they're in the tech sector, a lot of the stocks might be very similar to each other. Same with energy sector or any other sector. When you're looking at currency as an example, Forex, the Forex market, anything like an Aussie pair, Australian dollar, all Australian dollar pairs might look very similar. Just like all Canadian pairs might look very similar. All dollar pairs might look very similar, right? So there might be a time where, as an example, you might be looking at 4 really good pound long positions, meaning that you have 4 setups on your watch list that in every single one of them, you're looking to buy the pound. Now you can buy all 4 pairs, right? You can execute all 4 setups, but that means you're risking 4% on the fact that the pound is going to go up, right? That is a lot of risk on one major thing, which is pound going up, right? Or just like the tech sector falling down. That's a lot of risk on the tech sector falling down. So what you can do to eliminate that risk, let's go back to that pound example. Instead of executing all 4 pound pairs, right? You could execute the top 2 or maybe the top 1, your number 1 choice. I would say top 2 is a good option. If you have so many great opportunities in relation to the pound, that means that, yeah, probably the pound is going to go up because every single pound pair is telling you the pound's going to go up. That's a good opportunity. But you still might not want to execute every single pound pair because you'll be risking 4 or 5% on the pound going up, right? So you might only choose 1 or 2, your 2 favorite, and then only risk 1% or 2% on the pound going up. That is correlation risk. That is how you can eliminate correlation risk as well, is simply by making sure that you are not over risking on one major key, like the pound going up or the tech sector going down. Another way to avoid correlation risk is that sometimes you might have an opportunity. Let's talk about the Canadian dollar as an example. You might be looking at the Canadian dollar, Canadian US dollar, okay? You might be looking to buy the Canadian against the US dollar, and there might be a really good opportunity to do so. But you look at another pair, maybe Canadian Japanese yen, right, CAD yen, and you might be looking to short CAD yen, meaning that you'll be selling the Canadian dollar. So on one pair, you're looking to buy the Canadian dollar. On another pair, you're looking to sell the Canadian dollar, right? You'll have 2 totally opposite positions. One is buying the CAD and the other one is selling the CAD. That is also correlation risk. There's something off here, right? That is when you have to go dig a little bit deeper and see, look at all the other CAD pairs as an example. And is CAD actually strong or is CAD actually weak? If CAD is strong, then you're not going to sell Canadian yen, I mean. You're not going to take that Canadian yen position and actually sell the Canadian dollar because every single other CAD pair is telling you that CAD is actually strong. So then you're only going to execute Canadian US dollar long as an example, right? That is another way to eliminate correlation risk. So in reality, there's 2 correlation risks that you need to be familiar with. Number 1 is you don't want to risk too much on one major topic like Canadian strength. You might not want to execute 5 trades on that Canadian strength scenario as an example, or sell 4 companies within the tech sector at the exact same time. That's a lot of risk to the tech sector. So you might only just choose one option, one setup, or maybe 2 at max. Another way to, the second option for correlation risk is you don't want to take opposite positions. You don't want to take a Canadian dollar long and a Canadian short at the same time. That is pretty much trading against each other, right? One might be a win, one might be a loss, and then you're a break even. It doesn't make sense, right? So that's where you want to dig a little bit deeper to actually figure out, is the Canadian strong or is the Canadian weak? And then if it's strong, take the strong position. If it's weak, take the position where you're selling the Canadian dollar instead, right? That is again correlation risk and eliminating that. So that is it for correlation risk. That's something to also be familiar with. A lot of times you'll come across it mainly when you're making your watches and then all of a sudden you notice on your watch list that you're looking at every single Canadian pair or every single pound pair, or you have 5 stocks within the tech sector on your watch list. That is right away correlation risk. You need to go a little bit deeper, pick your number 1 or top 2 and execute those instead. So that is it for correlation risk, and I'll see you in the next lesson.